How's it going, everyone? It's Sam. I just sold a good portion, about 40% of a stock that I hold, one that I actually wanted to add to become a much larger position, but I never got to be able to do that. I never got to build it out enough, and now I'm actually selling it. And I want to talk about why that is and what I put the money into, because there is a kind of a problem in the market right now, and I am recording this on Tuesday, so it will be a few days before you see this, but there is a bit of a problem right now in the market, at least as of Tuesday. There aren't a lot of good deals. There aren't a lot of stocks that are significantly undervalued, in my opinion. So I had a bit of a problem trying to figure out where to put this money, but I think I did a pretty good job of doing that. So I want to talk about it. I will also talk about another stock that is in a similar position to the one that I sold, but I am not selling it for a handful of reasons. If you don't mind, hit subscribe, turn on that bell notification underneath the video. And if you want to get more information like this, why I'm buying or selling different stocks, you can check out the link to the Patreon underneath the video. Or if you want me to make more videos just like this, let me know in the comments section. Now, I won't beat around the bush any longer. The company that I sold a good position in was Microsoft. Microsoft is a great company that's growing consistently, has been around for a very long time, and is now the largest company, second largest company in the US, $2.58 trillion. However, it is getting to be pretty expensive. You can see the forward PE is about 27, and the trailing 12-month PE is about 37. Year to date, it's up about 40%, 41%. I bought a lot around 220 to 240. Now it's raised up to 336. I sold it actually for 340. And I'm not saying that it can't go up further, but when I look at the company, it's growing nicely, 10% a year in terms of revenue, 11% a year in terms of, or 14% a year in terms of EBITDA, free cash flow, 8%. It's a really good company with a deep moat that has consistent reoccurring revenue. They buy back their own shares. They pay a small dividend, about 0.8% dividend yield. However, it is trading at a very historically expensive number, 37 trailing 12 months. Usually it sells between about 25 and 30, give or take. And with it moving up this much in price, I don't see massive growth for it. Now, some people are bidding it up because of the AI revolution, basically thinking that Microsoft is going to be able to take advantage of this. Their cloud computing is going to take advantage of all the new companies that need all this data stored, and that is pushing up the company. It's trading at a prehistorically expensive PE ratio, and it's baking in a lot of growth. So if it trades between 25 and 30 PE, maybe even 35 PE regularly, and it's at that top end of the range, we still could have growth, basically, if it just continues to grow revenue 10% or free cash flow 10%, right? We could still grow 10% a year, but that's if we continue to keep that higher PE ratio. I think there's a pretty good chance it could fall down, and I've been seeing some other people talking about this recently. This is such a good company and such a consistent company. I really didn't want to sell it. I didn't want to I really want to build up the position more, and it's such a safe company too. It's got a better credit rating than the U.S. government, and it has $104 billion worth of cash. The net is $56 billion, so they're basically bulletproof right now. However, it's just expensive, and if you're an investor, you have to look and not just buy things when they're cheap, but also sell them if they're expensive. That is something that we try to do. Now, I didn't want to take out my position completely at one time. I think there's a chance I could still continue to run. We've been seeing that all year. Typically, though, I do have a bit of a bias, a positivity bias, where I think stocks and cryptos and assets in general will do better than they actually do, which is my own problem. I think a lot of us have it, though. So I did keep part of a position in it. I might scale back. If we continue to run, I might sell even more of it. But I do think it's smart to have some exposure to this company because it could take advantage of a couple different areas of growth. Now, where did I put this? Well, the problem is almost everything is expensive. All the companies that I've been buying that I like, that have deep moats, that continue to reward shareholders that are in growing industries, are ones that have gone up a lot this year. The main companies I've been averaging into over the last year and a half are Google, Amazon, and Tesla. Those are my three largest holdings. Then I've been trying to add more Microsoft and Apple, but they're typically very expensive. And if they're not expensive, typically other stocks fall down as well. So like Tesla at 100 looked better to me than Apple at about 130 or 120. So I did add to Apple, but I bought more Tesla because it was at a better valuation in my mind. So those are companies I've been trying to add to, but I just couldn't. But the companies I really like Amazon, Google, and Tesla, have been running a lot, 50% plus this year. I don't really want to add to those a significant amount. What I added to actually was Texas Roadhouse. And I already have a position in this. I grew my position a decent amount. But this is a company that I've been adding to for a year or so. It's one of my two main dividend stocks that pay significant dividends. It has a dividend yield of about 2%. That's not why I'm buying it though. I'm buying it because it's a consistent grower, 12% a year, compounded in terms of revenue, and it's at a 20 forward PE. So instead of a 27 on Microsoft or a 37, you get a 26 or a 20. So it is significantly cheaper, about 30% cheaper than Microsoft in terms of what kind of PE you're paying. And the free cash flow also growing about 15% a year. EBITDA growing significantly, 12% a year. Earnings per share growing consistently as well, 14%. So you can see revenues going up about 12% a year, but net income's going up even more than that, about 14%. So they're becoming more efficient as time goes on. Dividends are growing as well, about 16% over the last 10 years. It's been growing really quickly. Over the last 1 year, about 20%. Shares outstanding are actually going down. They're not paying off their employees with a significant amount of stock-based compensation, which is something I like to see. They're not diluting shareholders significantly with this stock-based compensation. Sure, there is some, but not a significant amount. And their return on capital employed is actually pretty good as well. You can see it's sitting around 17% for the last year, which is pretty good. That means that they're being able to take money in and get more than the cost of capital, around 8% to shareholders. So they're actually really good stewards of money and investment. They're actually able to take money and make more money from it instead of just burn it like a lot of companies. Now, I really like this company. It's been growing consistently. When you look like 20 years back, just been so consistently growing. And I do think that at a 20 PE, forward PE, it's not a bad deal. When we look at other companies, let's pull up Chipotle. It sells at a much more expensive number, 35 forward PE, 55 trailing PE. So you can get higher multiples in the food category. I mean, you can also look at other brands like Coke or Pepsi, but those are very different because they're products. This is actually a much better comparison because it is a restaurant. So you can get higher multiples. So I think there's room for some multiple expansion and just really consistent growth. So I am adding there. Now you might be saying, well, sure, you can be selling Microsoft, but why aren't you selling something like Tesla? Tesla is actually my largest position, and Tesla selling at a 75 trailing 12 months PE. Now, depending on where you're looking, you can see PEs from 28 to like 50 or 70. It just depends on what expectation you're having for next year. Personally, I think it's very likely we could have a much better year next year than this year. So if we look at the last quarter, right, you can't just look at one quarter for Tesla, but trailing 12 months, we're looking around $4 or so, a little bit less than $4, $3.75 or something like that in terms of PE. And a lot of that has been stalling out due to just the fears of recession. But with the economy looking like it's going to get back on track, possibly lower interest rates, or at least steady interest rates, where we're not having it become much more expensive every couple months to buy cars. I think people will start buying more Teslas, especially without fears of recession quite on the horizon as much too. And they also are becoming much more affordable with some of the EV tax credits that have come in recently. It's actually cheaper to buy a Tesla than it is a Camry in certain states. And that's just like the sticker price. That's just insane. If you buy a Camry in a state like California when you can buy a new Tesla for $25,000, I can't help you there. You just need to check yourself. But Tesla has so much possibility and is actually executing extremely well. So they've grown. Let's go over to the annual view here. Instead of 10% like Microsoft, they're around 50%. 10 years, 70%. 2 years, 61%. 1 year, 51%. And this does take out what we've seen so far in 2023. It just stops at 2022. But they are growing much quicker than Microsoft. Their free cash flow is growing much quicker than Microsoft. We can see that they might actually do a share buyback soon. They have a great return on capital employed, 25% and growing. They have other parts of their business that if they execute on, it could explode the stock price. I'm talking full self-driving. I'm also talking about battery storage business. We actually got news on that recently. They just got a $390 million contract to supply 224 Megapack 2XL units in Western Australia. So they can win large contracts like this. And this is the equivalent of like selling 8,000 vehicles. So they can win big contracts like this, and that can really help their bottom line, their top line. And it's something that's kind of irregular. People don't price this out. And they continue to have a dominant lead. Rivian just announced that they are going to be adopting their standard and be using their charging network. Hyundai is doing the same thing. I'm curious to see how they are benefiting from all these different companies, if all these companies are going to be paying Tesla to be able to use these networks, or paying for the upkeep, or paying to build more out. I can't wait to see how that all works out. But Tesla is a different beast in my head. It's like a call option and a share price. So unless it becomes much more expensive than it is now, I'm happier just to hold on to my Tesla shares. Microsoft, I don't see growing as quickly. I don't see multiple expansion for it either. I think Tesla still has a lot more room to run. And when you compare it to some of the other car manufacturers out there, they're building 5 times more vehicles than Tesla. And Tesla still has better economics, still bringing in more cash flow, more earnings. I still think it's very possible that Tesla could grow for 5, 10, 20 years into the future. And that's without getting into any of the crazy stuff like robots. Let me know your thoughts on all this underneath the video, though. Are you buying Microsoft? Are you holding off? Is there anything that you are buying in the stock market that you think is a screaming deal? Let me know in the comments section. Thank you so much for watching, and I'll see you in the next one. Bye.